So we're going to focus on, hey, you got an idea, you got a plan. It's not a huge $20 million raise. You can use exactly what we're going to talk about to do the bigger deals. However, we're just going to try to focus on you're getting started. You have some ideas. Now, what should you do? Attorneys, disclaimer, we are an attorney. We're not your attorney. We may be your attorney, but in any case, take all this as education, as a good way to waste your lunch. And, definitely look forward to having you as our clients if you're not already. Now, through this, we're going to talk about a few things. What's the goal? Really, what are you trying to accomplish? And what kind of structure you have to consider? What's the story? Well, who's your audience? Who are you communicating to? And what's going to make them, open up the checkbook? Finally, I'm going to kind of breeze through the planning you're offering. I feel like I've beaten the securities laws like a dead horse. So we're going to just really quickly go through that, but it is so important to the overall process. And then finally, we'll bring Amy and Parker on and we'll just really start to dive into marketing, different strategies, and what to consider. So I do hope that everybody gets a golden nugget or two out of this, and we always want to hear about it. So please, we will cut this off entirely in, 45 minutes. 4 questions. So if you do have any questions, please do the Q&A thing, add it to chats. We're here to kind of expand on really whatever you're looking for. And as long as it's not too personal, we'll go as deep into the questions as possible. So what's the goal? It really, at the end of the day, what's your business plan? Now, when you talk about a business plan, you actually are talking about a few different variations. And it always kind of comes down to, still, who's your audience? If you're writing a business plan for operations, it's going to look way different and include substantially different information than if you're preparing your business plan or pitch deck for investors. Or frankly, for banks. Everybody kind of considers different things. So really, everybody has that first starting off point. I need a business plan. I need to know what I'm doing. But what they don't think about is you really may need 3 separate business plans by the time everything is done. Because, to scale, you've got to have your operational business plan, your operations manual. That's frankly like the Bible of your business. Very important thing to do, especially as you plan to scale to the millions and millions and millions in capital, employees, and operations. From the finance side, with the banks, their considerations are very similar to investors, risk and reward. However, they are way more risk averse. So the background of the finance, what kind of assets will there be? What kind of guarantees can the bank receive? Kind of the net worth, if there are guarantors that are key principals or key parties that are outside of the business. It's really just what are you presenting? And then finally, why we're really here are the investors in terms of what to present with an investor. And let me just say this, if anybody likes a sample pitch deck, we're happy to provide it to anybody. It is, nothing more than a sample, but it is really important to know and to see and to think about if you're talking to investors, what are you presenting and what is important to them? Now, with any pitch deck or with any business plan for the investors, Some of the biggest considerations are, of course, who you are, who's the management, why should the investors believe in you? Also, what are you going to be doing? What are you targeting, a startup or an asset acquisition? And if you think, one of the biggest concerns is always the risk and reward. Frankly, at the end of the day, that's the most important thing for the investors. And this is why I bring it up here. Acquiring assets, if something doesn't work out, then you have assets to liquidate. If it's real estate, you may not get the great return that you are targeting. However, you will have something to sell. And actually, when we put together these types of deals, we call them often conditional offerings, meaning you're not even going to spend any money at all. You're going to have it impounded in escrow in a segregated account until you can actually acquire that asset. Why do you do that? Risk and reward. The exact same reason why with a new startup business, as an example, there aren't assets. And generally with new startups, you're spending money on leases, on employees, on things that are barely even depreciating, just kind of worthless because there's no long-term value. There's not something to sell until you produce whatever that product or end result is, or those assets that you acquire along the way. Well, that also means that your investors can lose 100% of their money. Risk and reward, that is far more risky than having an asset-backed play, which also means still risk and reward, you got to have better rewards. And there's multiple types of investors, because I am bringing up like the risk and reward is really important. However, there are quite a few investors. It's kind of a thing that the high risk, high reward investors they're generally high net worth, like to put money into a number of different business plans. And I call them the 10X investors. They're looking to 10X their money. And they also realize that plenty of their investments are going to fail entirely. If I had to give them, some percentages chances, 5 or 6 of their investments, they kind of have to expect they're going to go belly up. 3 or 4 investments should do relatively well, but really, they're investing for that one unicorn to knock it out the park. Forget 10X, they want 50X. And that's what those investors are looking for. But you definitely they're not going to be your bread and butter, because it is a small asset class of truly speculative investors. Most investors, the risk and reward is they just want a reasonable cash flow or reasonable appreciation with some designated exit strategies. Are you starting a business that you just expect them to invest forever? And if that's the case, how is cash flow going to be getting back to the investors? Just doing dividends or distributions all along the way without any plan to position the company for a sale, a merger, potentially an IPO? You always got to pay attention to the time horizon of really what are you talking to your investors about? Is this hey, we've got an idea, one of these wonderful napkin ideas, and we're going to take the company public and everybody's going to become multimillionaires from it. Wonderful. How long is that going to take? From a napkin to An IPO is a really long time generally. So but then also, how many companies actually do go public versus how many get started and fail? And that comes down to one of those classic statistics that 95% of small businesses fail. Investors take that into account. Investors know that as well. So if you're doing a business startup, just know that risk and reward wise, you got to be offering a large upside reward. And you kind of do that through the structure, but never forget about the exit strategies. If you're doing a real estate play, it's so much easier. We're going to do XYZ, rehab, sit on capital, sit on the cash flow for capital appreciation, eventually sell. It is few and far between that the exit strategy is we're going to roll everything up into a REIT and go public. It does happen sometimes. It's actually an option, but it's not really much of an option until you've got hundreds of millions of dollars in real estate. Don't worry about it with your first million. But, it does come down to what story are you presenting? And I like to bring this up because the story is as important as the substance. To start with, again, who's your audience? Because, they're considering different things and they are considering that risk and reward. But one of the most important things to always remember is, can you tell the story where your audience is the hero? And you're just simply the backup, the support to make their dreams work out. To talk about real estate investing, the investors, their dreams are retirement. They just want to be passive participants. In your story, why do people want to believe that you have the experience, have the performance, have the ability, education to help them, help your investors reach their end goal of retirement? Why is the property that you're targeting going to help them reach their goals of retirement? What's unique about the property? The surrounding geography, the access to certain commercial, office, or business areas that are close by. It is about building up the property, but never forget that the most important thing is your investors. They're your heroes because without them, you're never going to get across the finish line. They're there to help support your business. They're the heroes, and never forget that when you're developing your story, your pitch to them, your elevator pitch. You have to be able to explain very succinctly and simply who you are, what you're doing, what's your ask, and of course, why. It's always nice with a pitch if there's a possibility of incorporating some social benefits, environmental benefits. People, they just frankly love it. It is kind of an extra, feather in the cap. So that is a tertiary, I love that word, tertiary consideration to the investor's real goal, which is always that risk and reward structure. So you've been working on your business plan. You know what you're trying to accomplish. You know what you need to raise. You may not have the whole capital stack figured out yet, but you've worked on your pitch to the investors. You know what you're going to be presenting from a business side. Next, you actually have to prepare your offering. That's kind of where the attorneys come into play. There's quite a few other team members that you should expect to come together to help you out with your offering plan. And just to kind of touch on the different team members that you should always expect to have involved. Well, your attorneys. Now, we're securities attorneys. We're not, we generally don't provide the transactional representation, but you should have a business attorney, a real estate attorney, somebody that is always watching your back. We're here for the investments. Also, always remember your CPA. The CPA should be focused on the high level, complex tax considerations. They don't do all of your accounting because you also need your bookkeeper. That go-to person that's going to help you organize the information, make sure that you're consistently up to date. Big enough company, you've got your in-house bookkeeper, but there are some amazing companies out there that really are there to support you in terms of cost benefit. The bookkeepers are just simply a lot more cost effective than relying on a CPA to do all of your bookkeeping. So there's a good reason to kind of divide those. Plus, I actually like to not use my CPA firm to do bookkeeping for another really important reason: checks and balances. You do have the multiple parties looking at the same accounts, the same QuickBooks and accountings. They can catch each other if there's any mistakes that are made along the way. Also, we'll talk about real quick, just the technology. Nowadays, quite literally, 80% of deals are getting placed through online portals, crowdfunding portals. Crowdfunding portals can mean a couple of different things, but having the technology to be able to process your investors simplifies your life, maintains all the information, and rather than the good old-fashioned, hey, let's fax around some documents or let's send it by UPS overnight, all you got to do is point the investors to a website. They can process everything right then and there. Makes life nice and easy. But now to get a little bit more into planning your offering, and we'll talk first about real estate syndication, so mainly because it's at the top here. Very traditionally with real estate, there is a couple of different benefits that the investors are looking for. The depreciation, kind of weird that tax losses, not real losses, depreciation losses. That can be a huge benefit to the investors, but it's only a huge benefit to them in the cases that taxation is through partnership taxation. Now, for partnership taxation, you have capital accounts where all the profits and losses for an accounting and for a tax purpose flows down to the owners of the LLC, including yourself, the sponsors. A couple of different variations of not partnership taxation. You do have C corporations that really there are a couple of strategies why a C corporation, especially with foreign investors, can make sense for your investment. Secondarily, a REIT. I actually love REITs. They're more for larger sized funds. We don't do it too much. And for $1 million, we would never touch it. But that at least offers a simplicity of raising capital or of dealing with the taxes with your real estate funds. Generally, we're only doing REITs if we're doing like a $75 million Reg A offering. So we'll hop right over that since we're kind of focused on the getting a startup going. Now, with the partnership taxation, we generally have a distribution terms, distribution or dividend waterfalls. In this current climate, economic climate, real estate investors are more and more expecting a prioritization of their investments. We do that through a preferred return. Preferred return means it's not a debt, meaning you can't default if you don't have the money to pay it, but it is a designated percentage return rate that if and as cash is available, that's paid out first. There's a few different ways to slice it up with, cumulative, non-cumulative, compounding, non-compounding. Definitely just talk to your attorney about what makes the most sense for your investors and how to structure it. But now, more and more, there are these preferred returns. Secondarily, you have a profit split. And there's so many different ways to structure these. I always kind of think about preferred returns and profit splits like levers. You can increase the preferred return, decrease the profit split even down to zero. Vice versa, you can increase the profit split, decrease the preferred return, basically down to zero. But at the end of the day, it is really important to structure your offering so that your investors have a great chance to have a phenomenal return on their investment, because you want to get them excited. And prioritizing their interest through preferred returns, it's a great way to do it, but it's also not the only way. We do use pretty often a performance hurdle. So as an example, hey, I just want to distribute out to the investors 70%, as an example, of the cash flow and the profits. But if things don't go real well and the investors haven't gotten a great return, whenever we're selling that asset, maybe we're going to add a 8% performance hurdle. And Mr. Investor, if we look at everything that you've received, if you have not gotten an 8% return on your money, don't worry about it. We're going to back off of our 30% to the extent necessary to ensure you at least got your money back and at least got a 8% return. So that's on the real estate side. On the business startup side, there are so many different ways to structure that first capitalization. A couple of, one real attractive strategies are convertible notes, where the investors actually do come in as a debt holder. Maybe they're not getting payments up front because really you're just paying them with their own cash, but they have a secured priority interest. If the business doesn't work out, they have a claim against any remaining assets. So it puts them in a better position. It does designate a fixed rate. And if things go incredibly well, as all the investors always hope, they can convert into some sort of equity participation. That's a great strategy for getting things going and off the ground. Of course, the most traditional is a stock offering. Hey, we're just going to sell some percentage of the company. We want you to invest. This is why you should invest. Great. And then finally, more recently, they call them safe agreements. Safe agreements aren't really safe at all. I actually forget what the acronym stands for, but there's an acronym there. Hey, Parker, if you happen to look up what a safe agreement is, maybe throw that in the chat. But really, at the end of the day, these safe agreements, it's like an investment contract that allows the investor to take ownership. It doesn't represent ownership of a company. It represents an investment contract that there's generally some trigger. It may be time, it may be performance, it may be whenever the investor wants. They can trade in that safe agreement and become equity holders. You may not have heard of them before, but more and more, especially in the crowdfunding world or the venture capital world, these safe agreements are actually being really leveraged and used quite a bit. So, I had brought up the corporations, the REITs, partnership taxation. Honestly, we really default a lot nowadays to limited liability companies. The reason why we do is the flexibility. As an example, with an S corporation, you can only have one class of stock. You can only have split based on ownerships. It doesn't work with the preferred returns. We can structure these LLCs as complicated or as simple as you would like. And oftentimes we will create different classes within a deal for different purposes. You may have some investors that, hey, all I want is cash flow. Give me that preferred return. I'd rather maximize that, minimize the profit, but at least I sleep well at night. And you can have another class that's all split, no preferred return, because some investors really value that, the speculative, the capital appreciation. And that's the way that you maximize that versus the cash flow with the preferred return. We even do it where, hey, you may have one class for investors that come in at $50,000. But if you invest $200,000 or more, we're going to give you a higher pref or a higher split. So you can even within an LLC designate different classes and have your investment where there's actually options for the investors. Investing into the exact same asset, exact same business, but the way that they receive their return actually can be completely different from one class to the other class. And then finally, I brought up taxation. LLCs, there's not a taxation category at all for an LLC. And with the IRS application, it defaults, well, if it's single member owner, a single member owner, it is a disregarded entity. The IRS ignores it completely. If it's multi-member, it defaults to this partnership taxation. And that's kind of what I had talked about before with the capital accounts and the flow through of the profits and losses. The investors get a K1. But with an LLC, you can also choose to be an S corporation. You can choose to be a C corporation. Or as long as you meet all the requirements, an LLC can even be a REIT. Now, I always think this is weird, so I'm going to bring it up. A REIT is a real estate investment trust. Traditionally, it's a C corporation that's taxed a different way. I always just thought that was uniquely strange. So you can use an LLC to create this real estate investment trust. So it does just kind of offer that flexibility. More and more, I mean, limited partnerships used to be used a lot. LLCs is the new kid on the block. The series LLC is even a newer kid on the block. And every year that goes by, there's more case law, there's more protections. It's been challenged more and more and more to make sure that if something happens to the business, to the real estate or the assets of the business, or frankly, if you get sued, what rights do a creditor have against the assets of the LLC? Or what options do the creditors have of reaching your assets? And with LLCs, limited liability companies, you do want to make sure that, they call it piercing the corporate veil, where in certain circumstances, creditors actually can reach through and grab your assets. But again, just make sure you work with a good attorney, whoever that may be. They're going to make sure that that doesn't happen and give you proper coaching on that. So we're burning through time way too fast. So like I was saying, I'm not going to get stuck on these securities at all this time around. But you always got to remember, with the different securities options, do you care about whether somebody's a accredited investor or sophisticated or everybody else? Now, we're just about to talk about marketing, and there's really kind of two directions of marketing. The non-general solicitation, the non-advertising marketing, that's for Reg D 506B, which and really friends and family. And there are some strategies you can use with that. But really, we're not going to focus too much on that. But where you can do online marketing, general solicitation, this 506C, there's also a Reg D Rule 504 that you can do this online marketing in some cases. Most often, it's only used for intrastate, for investment offerings that are all within the same state. And I'm not going to talk about Reg CF is regulation crowdfunding. And then you have regulation A, which is kind of like a mini IPO. It's the big dog. And so with that, Parker, Amy, AA, would y'all be willing and available to join us?
Absolutely.
Hi, Amy. It's always nice to see you. And since you are working from home, we did have to ask, are you wearing pajamas?
I am not today. I'm fully dressed.
Well, that's good. Give us a little bit of extra comfort. But you know what? If you don't mind, can we kind of start with your opinion on with online marketing and kind of reaching as broad or targeted an audience as possible? What kind of strategies, just kind of naming them and we can dive into them, do you like to use to reach new people?
Well, as you were talking, I got really excited. I was hidden behind the camera and I was on mute, but I got really excited because you started talking about being, a hero to somebody and your audience is the hero. And so, we say it over and over again at Crowdfunding Lawyers. Keep it simple, stupid. It's our KISS philosophy. Whether you're raising 10,000 or 10 million, focus on your W's, on who, what, when, where, and then how. And so as long as you keep to that, it really is about keeping it simple.
Yeah. Absolutely love it. Parker, what do you think?
Well, I couldn't agree more with Amy. Whenever you overcomplicate things, like a lot of things can fall through the cracks, right? Deals can go bad. I mean, maybe you lose just track of some valuable information, potentially lose leads, and just countless things. So there's a big reason why we keep it simple, stupid here.
Yeah.
I love it. For somebody that's just kind of getting started, they may have a little network. They have a Facebook or Instagram account, but they really haven't done much on it. What kind of advice would you give somebody that's looking to take over the world, but starting off with Smurf Village?
And those were also my thoughts also when we were talking, is start with your foundation. What are your goals? What is the root of why are you doing this? Who are you speaking to? And what's in it for them? While we all like to think it's, we're going to make a profit, we're going to grow our business, we're going to grow our net worth. Ultimately, people want to know what's in it for them. And when you can speak to that and you can build from a foundation that's goal driven, and you have to put in the work. I mean, it's not just easy money. But when you follow through on your goals and they're rooted in a foundation, then I think that's the best advice I could give anybody.
Mm-hmm.
Love
Absolutely.
it. Parker, how do you feel about social media? How do you feel about Facebook or Meta or whatever you want to call it nowadays?
I'm sticking with Facebook. I've been seeing a bigger push on trying to change it over to Meta, and I saw they even want to call their people I believe it was Meta Nights or something like that. I'm staying with Facebook. That's the one I grew up with and I know and love. I think social media is a phenomenal platform. I know a lot of people tend to dog on it and talk negatively, but not even just from a social perspective, keeping up with your family, but yeah, if you're wanting to network with other professionals, other entrepreneurs, potentially leverage that to gain some investors, things like that. Social media is incredible. It's a pretty easy tool to work with, especially whenever you understand or have a higher understanding of doing specific keyword research and things like that. Very, very valuable. And in today's day and age, if you're going to run a business without social media or try to start a business without social media, good luck.
Do you have a favorite and a most hated, Parker, social media network?
Favorite. Now, is this for On the business side or personal side? Yeah, actually, I'll answer both. So
No. It's about, again, the audience. The guys that are trying to raise capital, where do you think they're going to get the most traction nowadays?
I say LinkedIn would be a really good place to start. Facebook would be a close second, but definitely start investing more into your LinkedIn company page. Do a whole lot of that, and then I guess my least one. Now this kind of varies on the industry, but Twitter, I just don't really see a whole lot on there unless you're like an entertainer or if you're able to leverage your brand in the light of like doing a bunch of memes and things that necessarily aren't the most professional. Let's just say that. Because things like that on Twitter can go viral pretty quick. But that's Twitter still my least favorite.
I still miss MySpace, but that really is. Amy, what do you think?
LinkedIn is huge. LinkedIn for B2B investors, building your network. There's a reason why they call it connections, and the reason why they organize your profile by first, second, and third, because there is a true value in interpersonal relationships. And once you've reached within those 3 degrees of connections, then the value is immense. So anybody that's reaching out B2B, LinkedIn is incredibly powerful.
Love it. Let's talk about email blasts. I mean, yeah, anybody can go and buy a list of emails. You can even say, hey, all I want are $1 million net worth or high income individuals in this area. And then just send out an email blast. Blind, don't know them. Do you know kind of the stats on success with that, what people should expect, or what are your thoughts, Amy?
Well, what we always try to do as well is take a personalized approach, because it comes back to that interpersonal relationship. Whether you're talking about an email blast or a social media network, ultimately it gets down to your relationship with the person and selling your product or investment, who you are in some capacity. So, there's different bounce rates that are acceptable by different industries. And then obviously, if you have a mailing list of 10,000 versus 10, there's no rule of thumb. I could get really granular if you want, but I know that's not the time. But as long as it's goal driven and you're understanding why people unsubscribe, why people engage, why they show up at your webinar, then you're getting down to who the person is and how you can help them.
Love it. Parker, what do you think?
I mean, I feel like Amy took the words right out of my mouth. I mean, everything she just said. I will say, watching the bounce rate is a very important thing, especially to a lot of people who are new to doing the email marketing campaigns. Because if your bounce rate goes too high, Google, it can recognize that as spam, and then more and more of your emails can potentially get sent as spam. So if you are new to the email marketing side, that's something to be very wary of.
So now I'm sure a lot of people, including myself, what's a bounce rate? What does that even mean?
Sorry, are we speaking Greek?
We're just lowly little attorneys over here. We don't know much of anything other than how to protect our clients.
Yeah.
I hope somebody has that answer, because I wasn't lying. What's a bounce rate?
Basically, if the email comes back to you, it bounces. It could be through an IT security filter. It could be because the person's unsubscribed and you've made an attempt, which is a big no-no. Various reasons. And so the internet and the World Wide Web is very smart, and they want to make sure that people are trusted when they're sending. So your domain authority and your website is really important when sending things out. So.
Yeah. Just a really simple way to put it is it just kind of, your email gets identified as a spam, more or less, is a very low level way of explaining it.
Got it. Well, I think we need to stay very low level, under the clouds, because way too much, especially when it comes to this online marketing, newfangled gizmos. Can we put up a billboard and does that work nowadays?
What's that? A billboard?
Ouch. I continue to feel more and more dated. So thank y'all. I'm going to go hop onto my wheelchair and slowly get on out. Now, and so, one of the things that I do like to harp on is consistency of the message and getting it out on a regular basis. Can you speak a little bit to making sure that you're staying constant and really what that helps and why?
Yeah, I can touch on that. So consistency, especially from the social media or just marketing in general, you want to stay on top of mind whenever you're reaching out to people, especially today's day and age. Attention spans are getting shorter. There's just so many ads and information being thrown at people. That's why it's very, very important through your social media. Be not as aggressive whenever it comes to your email marketing compared to your social media marketing, but you still want to send that out. Absolutely. Be consistent on that, because you're just fighting for people's attention. You're fighting for their timeline space or their screen space. And also on top of that too, for the social media, if you stay consistent, that just makes the algorithms happy as well. And you'll pop up on their feeds more frequently and more often.
Perfect. Amy, anything to add to the wonderful explanation?
Well, I have a consistency in the sense of business development and how you can stay focused on growing your portfolio, growing your investments, and that's building a community of people. We're building a community today, whether we realize it or not, and following those people that are thought leaders, following people in the industry, learning from others, and then developing a community of people that can keep you accountable to your consistency, your business development. It's not really the answer to the question you were asking in a marketing perspective, but I just wanted to get that in there.
I love it. And kind of one of those statistics, and I'm so data driven. Statistics I never forget is on average, you're touching an investor 6 times before they're actually investing. Now, that may be emails, it may be interviews, YouTube, social media, everything else, podcasts, but it isn't a one and done. All right, I shot out this email. Now I'm going to sit back, twiddle my thumbs, and wait for everything to show up. It just doesn't happen that way. And so that, at least from my perspective, is always something important to remember. So if y'all don't mind just kind of hanging out, I'm going to go through the rest of this. We got about 5 more minutes and then do want to open it up for questions. So if y'all don't mind just kind of hanging out, and Parker, maybe you could quit working so hard so we don't hear all of your clicks, but appreciate you nonetheless.
Yeah. Oh, my pleasure.
I'll hang out.
Awesome. All right. Now, just to really to dovetail back around to you're doing an investment offering, what can you communicate? And when can you communicate it? And I'll say, nowadays, and this is different than in years past, you are allowed to, they call it testing the waters. Get out there, talk to your investors, prospective investors. Send out the email blast. However, there are some specific rules around talking about an investment before you actually have your offering together and available for investors to actually deposit funds. And the requirements are, make sure they know you're not asking for money. You're not accepting money. You're not accepting any binding commitments to invest. And most importantly, you're still working on the deal. So you're not giving any sort of impression that, hey, you've got it all figured out, worked out, you're ready to start moving forward with stuff. The reality is you can test the waters, you can get out there and start your marketing. However, just make sure that you're not saying, well, give me your money now and we'll get you the documents later. That will definitely still get you in trouble. Also, when it comes to your communications, your advertisements to investors, the SEC is now really, really, really harping on the risk and reward, a fair and balanced presentation of the information relating to your investment. Don't say you're going to make 20% returns if you're not also going to say, and you can lose all of your money, as an example. And at 20% returns, people don't really believe consistently they'll get it, even though there are some of those knock it out the park investments that are above 20% returns. Kind of just part of the whole process of communicating with your investors is to really make sure that you're staying with being honest, open. Don't mislead people. So that's how to communicate. Well, just making sure that you're not being overly aggressive. Don't talk about, hey, your investment is guaranteed. In the private offering, private securities world, nothing is safe. These are speculative investments. Even if you're investing into, hey, there's this cash flowing apartment complex, as an example, it's been, fully leased out. It's been kicking off cash flow for the last 20 years. It's safe. Well, the reality is, at least from the regulator's perspective, there are always risks. And doing this as long as I have, I've definitely seen those safe investments completely go belly up. For better or worse, I cut my teeth on a lot of those bad deals because I was actually practicing in Las Vegas over a dozen years ago when the Great Recession kind of kicked into high gear. And I was just seeing safe investments dropping like flies when the whole market kind of turned around. So just remember that there's nothing that's guaranteed in this world, death and taxes. Nothing in the private investment world is safe. And if you start promising returns, if you start guaranteeing things, just know that there's a high chance it could come back onto you. And what do I mean by that? If a regulator or court finds that you've been misleading investors, they can hold you personally responsible. And you are now guaranteeing the investors their funds, at least as a debt that you have to pay back. And guess what? You can never bankrupt out of it. That's why this stuff is so incredibly important, especially so you don't have the goal of don't get stopped by the regulators. They do have on a regular basis where they'll cease and desist. They'll stop offerings from being able to take place. So I am going to fly right through a lot of this stuff because absolutely want to take some time to answer any of your questions. Parker, if you don't mind being the questionnaire of all people, and Amy, please help me out as appropriate.
All righty, y'all. We got a few questions here, Nate. Appreciate everyone being here with us today and participating. We got a lot of people in the chat. We got some good questions. So thanks, everyone. This is awesome. So Nate, let's jump right into this. The first question is, how can I market to sell my private pharmaceutical stock that is pre-IPO to raise cash for real estate purchase?
That will come down to those various securities exemptions, private investment exemptions. Really what you choose comes down to, at the end of the day, how much capital you're trying to raise and who you're targeting to raise capital from. If you're looking to IPO, some great options are actually a Regulation A offering. If it's a large enough capital raise, it's like a mini IPO. You go through a qualification with the SEC and you start having to do some, but not as extensive as an IPO, reporting with the SEC every 6 months. But it really it's one of those, definitely talk to a competent attorney. There's my information and would love to kind of help you out with that.
Awesome. Next question. Can you legally raise money for other syndicators? And if so, how?
That is a massive area that can be a webinar unto itself. I will say, if you're trying to be compensated for raising capital, that is solely a broker-dealer activity. There is a issuer exemption for, the rules are you're working with the company, you have responsibilities beyond just raising capital, you're expected to be with the company for longer than the offering period, you haven't been with the broker-dealer over the past year, and there's a bunch of bad boy reasons why you still can't rely on that. The last option, just to bring it up, there are finders, and finders don't get paid a commission. They don't get paid a performance fee, but they do get paid for a fixed amount generally for introducing possible investors.
Mm-hmm. Awesome. Great, Nate. Another question here. Is there a difference in how you recommend qualifying a non-accredited but sophisticated investor on business startup / expansion funding versus a real estate syndication?
The considerations are always the same in terms of sophistication. Do they understand what they're investing into? Do they understand the risks based on their prior experience, investment experience, education? But what I think you really should be targeting and looking at is the suitability of the investor. If they're 80 years old, they should not be investing into a fund that's illiquid for even 5 years. Definitely not 10, 15 years. So in terms of suitability, absolutely, it's a very important component, which is distinctly separate from the sophistication.
All right. All right, Nate, how about this one? If a foreign investor controls a US-based LLC, does the LLC need to qualify as an accredited investor, or would the foreign investor qualify in 506C?
Kind of just depends on what type of, again, securities offering. But if they're investing through a US-based entity, then it is a US-based investor. Then the entity itself has to qualify as an accredited investor, which 100% of the owners being accredited, that's kind of the go-to for an LLC of whether or not it's accredited. However, there is actually a Regulation S that, as long as the foreign investor was solicited and everything's happening internationally, Regulation S doesn't even care if the investors are accredited or not. Just don't mislead. The rules against securities fraud still apply, but the SEC doesn't have as high of a bar of, the way that they see they don't need to protect the international people. That's what their countries are for.
Great. And we got, I believe, one more question here. And this is actually a marketing question. So, Amy, I got a curveball for you. How do you stop bounce rates on your emails? Or what are some ways to prevent bounce rates?
Sure. So when it comes to email, I mean, we could have an hour-long discussion about this. Sorry, encapsulate it. But there's basically...
Join us next time on the AA show.
There's two types of bounce. There's a hard bounce and a soft bounce. And so you need to figure out which one it is. Do a quick Google search on the difference between a hard bounce and a soft bounce. Some are temporary and others are permanent. And so essentially you need to keep a good email hygiene practice, good email list, and make sure that those that are hard bounces don't stick on your list, because it, the Google gods, as I call them, and other email servers will, ping you for it and affect your credibility. There's a lot of other things as well, but that's good email hygiene is the best tip I could give you.
Mm-hmm. Absolutely. All right. I do see a few people just asking how they can get their hands on the pitch deck. We could do, what if y'all, anyone who wants a copy of the pitch deck, you can email me. That was Parker@crowdfundinglawyers.net. I can type it here in the chat. And then For everyone who wants that, just go ahead and shoot me an email, then I can follow it with you soon and send the pitch deck over your way.
All right. Thank you so much, Parker and Amy, for making this way more interesting than me pretending like I know anything about marketing. So thank y'all so much for joining, and everybody else. Thanks for spending your hard-earned lunch with us today. I definitely look forward to doing more of these and hope you have the time and attention to learn a little bit extra as well.
Awesome. Yeah. Thanks, everyone. Also, check us out on social media, please. I did put all of our @ names right at the top, but you just look us up, Crowdfunding Lawyers, Facebook, Instagram, YouTube, LinkedIn, all the platforms. So definitely check us out so you can stay up to date with us.
Thank you, everybody.
All right. Bye, everyone. Have a nice day.